There's a photo going viral this week. The fearless girl statue bronze, defiant, hands on hips standing in fresh snow outside the New York Stock Exchange. Behind her, traders in wool coats hustle through the cold. Above her, the numbers keep climbing. The S&P 500 just hit another all-time high. The Dow's up. Tech stocks are surging. And if you're watching from the outside, it all looks fine, great, even. But here's the thing about record highs. They're only records until they're not. Let me tell you what's actually happening right now. Beneath the snow and the bronze and the green numbers flashing across CNBC, the US stock market is climbing. But it's not climbing because the economy suddenly got stronger overnight. It's climbing while the dollar, the actual currency in your wallet, just hit its lowest value against other currencies in nearly 4 years. Think about that for a second. Stocks up, dollar down. If that sounds contradictory, that's because it kind of is. And understanding why tells you almost everything you need to know about how fragile this moment really is. Let's start with what you're seeing in the headlines. Wednesday morning, January 28, 2026. Markets open. The S&P 500, the index that tracks 500 of the biggest companies in America, rises another 0.3%. The Dow Jones adds 114 points. The Nasdaq, which leans heavy on tech, climbs 0.5%. Not dramatic, not a rocket ship, just up. And honestly, that's been the pattern for weeks now. Steady, incremental gains. The kind of market movement that doesn't make for great TV, but quietly pads retirement accounts and makes investors feel smart. But zoom out just a little, and something stranger comes into focus. While stocks climb, the dollar is falling, not crashing, not collapsing, just steadily losing value against the euro, the yen, the pound. It's now at its weakest point since early 2020, to a time when inflation was still raging and the Federal Reserve was scrambling to get control. So, why is this happening now? Here's the simple version. When the dollar weakens, American companies that sell stuff overseas suddenly become more competitive. A European customer buying an iPhone pays in euros. If the dollar is worth less relative to the euro, that iPhone effectively gets cheaper for them. Apple's revenue goes up. Apple's stock goes up. The S&P 500, which Apple is a huge part of, goes up. Multiply that across hundreds of companies, and you get what we're seeing. A stock market that benefits from a weaker dollar. But here's where it gets uncomfortable. A weak dollar also means everything America imports gets more expensive. Oil, electronics, that French cheese you pretend to understand at Whole Foods. If you're a company that relies on foreign goods, your costs just went up. If you're a regular person buying gas or groceries, your money doesn't stretch as far. So, the market's rising, but your purchasing power is shrinking. The stock market is not the economy. It's a distorted mirror of the economy, reflecting the fortunes of the people and companies who own assets, not the people who just live here. Now, let's talk about why the dollar is falling in the first place. There's no single cause, there never is. But one big factor is interest rates, or more specifically, the expectation that the Federal Reserve might start cutting them. Here's how that works. When interest rates are high, holding US dollars becomes attractive. You can park your money in a US Treasury bond and get a decent return. Foreign investors love that. They buy dollars to buy those bonds, which keeps demand for the dollar strong. But when the Fed signals it might lower rates because inflation is cooling, or the economy is softening, those bonds become less attractive. Foreign money flows out. Demand for the dollar drops, the dollar weakens. Right now, markets are betting that the Fed is getting ready to ease up. Inflation has come down from its 2020 peak. Growth is slowing. The labor market is cooling. All signs point toward the Fed cutting rates sometime in 2026, and so, the dollar falls. Which, again, is good for exporters and multinational corporations, which is why stocks keep ticking up. But it also means we're in a very delicate moment. The market is betting on a soft landing, a scenario where the economy slows just enough to tame inflation, but not so much that it tips into recession. That's a narrow path, and historically, narrow paths are easy to fall off. Let's get specific. Wednesday's rally was led by tech stocks, and the catalyst was a single company most people have never heard of, ASML. ASML, a Dutch company that makes the machines that make computer chips, not the chips themselves, the machines. Specifically, extreme ultraviolet lithography machines, which are so complex and expensive that only a handful exist in the world. They cost over $150 million each, they're the size of a bus. And they're absolutely essential to making the most advanced chips on the planet. Every cutting-edge processor in your phone, your laptop, your data center, it came from an ASML machine. So, when ASML gives a forecast, the entire tech industry listens. This week, ASML said it expects 2026 revenue to exceed analysts' expectations. The reason? AI, artificial intelligence specifically, the massive computing infrastructure required to train and run AI models, is driving what ASML's CEO called the sustainability of chip demand. Translation: the AI boom isn't slowing down, it's becoming structural. That's the kind of news that sends tech stocks soaring. Nvidia, AMD, Apple, they all climbed. And because tech makes up such a huge portion of the S&P 500, the whole market followed. But here's the tension underneath that rally. The AI boom is real. The money being poured into it is real. But no one really knows yet if the returns will be real. Think about it this way. In the late 1990s, everyone knew the internet was going to change the world. And they were right. But that didn't stop the dot-com bubble from imploding in 2000, wiping out trillions of dollars in value. The technology was real. The hype was real. The infrastructure got built. But the gap between this will be huge someday, and this is profitable right now turned out to be a very expensive chasm. AI feels similar. Companies are spending billions on data centers, chips, and cloud infrastructure. They're racing to integrate AI into everything from customer service to drug discovery. The potential is enormous, but very few companies are actually making money from AI yet. Most are still in the spending phase, which raises the question, what happens if the returns take longer than expected? What happens if AI becomes the next eventually revolutionary, but not yet profitable technology? Do the stocks that have been bid up on AI expectations hold their value, or do they correct? ASML's optimistic forecast helped calm some of those fears this week. It suggested that the demand for AI infrastructure is not just hype, it's durable. Companies aren't pulling back, they're doubling down. But that only works if the economic backdrop stays favorable, and right now, that backdrop is shaky. Yes, inflation has cooled, but growth is slowing. Corporate earnings are under pressure, consumers are pulling back on spending, and the geopolitical situation, trade tensions, conflicts, political instability remains a wild card. The market is climbing because it's betting on the Fed threading the needle, on rates coming down, and just enough to support growth, but not so much that it signals panic. That's a bet, not a certainty. Here's the part that doesn't get talked about enough. When the stock market hits record highs, it feels like good news. Politicians tout it, cable news celebrates it. Your uncle at Thanksgiving brags about his portfolio. But for most people, the stock market is not their life. About half of Americans own no stock at all. Not directly, not through retirement accounts, nothing. For them, a record high S&P 500 means approximately nothing. What they feel is the weak dollar, the higher cost of imported goods, the squeeze at the grocery store, the anxiety that even though the headlines say everything's great, their paycheck doesn't go as far as it used to. This is the paradox of modern markets. They can thrive even as ordinary economic conditions deteriorate, because the stock market reflects the fortunes of capital, not labor, of assets, not wages, of people who own things, not people who just work. And right now, the people who own things are doing very well. So, where does this go? The optimistic scenario is that the Fed manages the soft landing. Growth slows but doesn't collapse. Inflation stays in check. Corporate profits remain healthy. The AI boom delivers real productivity gains. Stocks keep climbing. That's possible. But the pessimistic scenario is also possible. The Fed cuts rates, but growth slows anyway. The weak dollar accelerates, sparking a new wave of inflation. AI investments fail to deliver returns, and tech stocks correct sharply. The market's narrow leadership, where a handful of megacap tech companies carry the entire index, finally cracks. And then the record highs start looking less like strength and more like the last gasp before a fall. There's a reason the fearless girl statue resonates right now. She's small, she's standing in the snow, and she's staring down one of the most powerful financial institutions in the world. It's defiance, but it's also vulnerability. Because markets, like statues, don't move on their own. They're moved by forces: human decisions, economic pressures, fear, greed, hope. And right now, those forces are pulling in different directions. Stocks up, dollar down, AI surging, growth slowing. Record highs built on narrow foundations. It all holds together until it doesn't. So here's the question to sit with. When the market climbs while the currency falls, who's actually winning? And more importantly, how long can they keep winning before the math stops working? I don't have the answer. Neither does Wall Street, honestly. But I do know this: markets don't stay at record highs forever. Gravity always wins eventually. The only question is when.